Okay, welcome everyone to the February 2023 RS Crum market update. Today's market update is every other quarter. We're going to be doing a shorter form market update, and then the other 2 quarters it'll be a longer, more discussion with a panel update. Today's is going to go a little bit longer than my previous ones, probably about 30 minutes or so. But I believe, this is my personal opinion, I think there's some great information. So make sure that you stick around for the, for the whole presentation. Today happens to be Valentine's Day. So I want to welcome everybody or wish everybody a very happy Valentine's Day. And also it's the day that the next inflation report comes out. So expect either probably a roller coaster in the stock market, up or down, which has been typically happening so far. So the forecast is that inflation will tick down a little bit, but we'll see. So anyway, with that said, let's go ahead and get started. Let me go through the agenda today. One is give you an economic update, talk about inflation, interest rates. Are we headed to a recession? In fact we are, it's the most telegraphed recession probably in history because people have been talking about it for a year. Then we're going to go into the financial markets. We talk about current valuations, given the stock market's kind of, gone down and then back up. Talk about the bear case versus the bull case on the stock market going forward. And then, share with you a few opportunities in the market that we hopefully can take advantage of. So let's get started. Let's talk about inflation, because this is still on everybody's mind, and it has become the biggest issue from polling data, and for obvious reasons, as we all know. The cost at the pump and the cost at Costco and the grocery stores and whatnot. So this is kind of a start off with a joke. The new Fed introduces the new $1 bill. And it's really it's a joke, but it's not a joke, because since the United States got off the gold standard, there has been a systematic debasement of the dollar. So literally, I don't know what a dollar 50 years ago is worth today, but it's probably $10 or $20. So not too far from the truth. The reason for the inflation, as we have all been told over and over again, but just to kind of lay it out here, let me get my little highlighter here. Actually, let me get my little pointer. Is, inflation is caused by supply and demand. So if demand exceeds supply, then you see inflation. Now, a couple things. One thing that created massive demand is all this quantitative easing and all the debt stimulus money. And as you can see right here, starting during the pandemic, we have added $5 trillion of stimulus in the form of PPP loans, employee retention credits, just money that just went out to normal consumers. And then we also had the double whammy of supply chains being constrained due to the COVID lockdowns in China and the shortage in microchips and things like that. So those things have started to kind of work through the system, at least the supply chain stuff with China opening back up. But these are things that the Federal Reserve can't control. They can't control the supply side, but they can control the demand side. And so, as you can see, one good thing is they have, and this is under the radar, they meaning the Fed, has been lowering their balance sheet and rolling off. And as you can see in 23, 24, 25, we'll go from, just under $9 trillion on the Fed's balance sheet to, a little over 6. So if they can continue that, that's a good thing. And so we'll see how that goes. Okay, let's look at inflation last year. So in 2022, we started at 7.48% in January. So this is 13 months ago. So inflation had already been ticking up. We peaked in June at over 9, and then you can see we've steadily been going down 8.5, 8.25. all the way to the December number, which was 6.45%. And then, as I said, today, the new number's coming out today, and I think it's expected to be 6.2. We'll see what happens. That's the way markets work. If it's 6.2, the market will probably go up, because inflation is still ticking down. If inflation is higher than 6.45, then the market will probably sell off as it's reevaluating how sticky inflation is. Okay, so let's go switch to interest rates. So this is the interest rate hike schedule that took place last year. So you can see starting at basically 0% interest rates. I think it was, maybe 0.25%. We have seen, 25 basis points in March, then 50, then they kicked it up to 75 in June, 75 in July, 75 in September, all the way up to the February price interest rate hike of another 25 basis points. So in total, it's about 4.5% interest rates have been increased by the Federal Reserve. Significant. I believe it's one of the fastest, if not the fastest, rate increases in, 50, 70 years, something like that. Don't quote me on that, but it's significant. Okay, now this is basically the expectations of interest rates now. So as you can see, this is a little dated. I don't think it included the February increase. So 4.38. I think I showed it was 4.5 something. And the market, actually the blue thing is what the Federal Reserve is expecting themselves to raise interest rates to a little over 5, and then they see in 20, you can see this is 24 peaking at 5 and then steadily going down. This is what the market is expecting, and this changes. This, again, this slide is probably 3 weeks old, so it has changed from there. The market is believing that the rates are going to come down even more than the Fed is saying that the interest rates are going to come down. So basically, they don't believe the Fed, and there's been a lot of talk in financial journals and TV that they're waiting for the so-called "quote unquote" Fed pivot. I'm sorry, the Powell pivot, where they believe that if markets get a little squirrely out there, that Powell might start lowering interest rates sooner than later, just like he did in 2018. The fourth quarter, this is the last time that Powell and the Federal Reserve tried to raise rates. They got I think they got to like 2 or 3%. And then in December of 2018, the stock market went down 20%. And Powell pivoted. He freaked out, started lowering interest rates, and certainly paused his interest rate increases. And so they're expecting him to do that again. Now, half the people are saying, hey, Powell is dead serious this time. And so he's going to stick with these high interest rates until inflation gets much lower. So we'll have to see what happens. So far, the market is pricing in lower interest rates than the Fed is saying. Okay, so this is, you may have heard us talk about yield curves, and this black line is from a year ago. And you can see this goes 3-month treasuries, 1-year treasuries, 5-year, 10-year, all the way to 30-year treasuries. Now, a normal yield curve is upward sloping like this is. And the reason being, and it kind of makes sense, is if you're going to lock your money up for 30 years or 20 years, they should pay you higher interest rates because it's higher risk. Now, what happens when there's a negative yield curve, you can see the slope is the exact opposite. And this is what we're seeing right now, where you have 3-month treasuries and 1-year treasuries in the 4.8, 4.7% range, while 30-year treasuries are 3.65 and 20, and even 10 years is 3.5. And so basically what that means is the Federal Reserve, they can control the short interest rates, but the longer term interest rates they can't control. And basically what that says, if the 10-year is 3.5, they're saying that they believe growth and inflation will be much lower in 10 years than it is right now. And we certainly hope so. So I've showed this to you one or two times. This is the actual screen from Charles Schwab, kind of showing the yield curve. And if we just look at U.S. Treasuries right here, this is from November 8th. This is what I showed at the last webinar. So 1 year was at 4.8. And 10-year, you can see it was 4.1. Now, flash forward to a couple days ago, the 1 year is still at 4.8, almost exactly the same, but the 10-year, as I just showed you, has come down to 3.5%. So basically, it's become even more inverted since November. Now, one effect of higher interest rates is, people have talked about this, is, the government has to pay these higher interest rates. So this is, pretty amazing statistic is last year they paid $850 billion in interest for 31 trillion in debt, which was more than the entire defense budget. So these interest rates, they help the consumers by paying higher interest rates on their investments, but it also can hurt. This is where the government has kind of a mixed emotions, is they pay higher interest, but also the debt is worth less because it's in inflated dollars. So just something to keep an eye on. Okay, so let's look at markets and how this inflation and higher interest rates has affected the real estate market. Start off with, we showed you last time that the mortgages went from already 2.65% 30-year mortgages all the way up to 7%. And as you can see, it's been dipping down to about 6%. In fact, I saw something yesterday that I saw like 5.75 or even 5.5% interest rates on adjustable rate mortgages. So like a 10-year fixed, ARM product was about 5.5, 5.75. So rates are starting to settle in. However, these high interest rates, coupled with the increase in prices, now it's softening recently, but over the last 2 years, real estate prices, the median home sales price for U.S. homes overall was up 34% over the last 2 years. So you take higher interest rates, higher prices, and you get this chart shows the affordability index. So it basically says what's the housing payment as a percentage of median income. So back in 2020, it was like 29% of people's household income went to housing. Now it's 46%. So that is substantial. And so basically what we've seen now is existing home sales have fallen off a cliff. Now prices are softening, but they haven't fallen off a cliff, but certainly transactions have. So you can see, 4 million, I guess, transactions. Well, let's just talk about it on a relative basis. So the number of housing sales is back where it was during the last Great Recession in November of 2010. So one thing that Jerome Powell and the Federal Reserve wanted to do was slow demand. And the biggest and fastest way to slow demand is to make people feel poor, or to cool home prices, which was something that got out of control. So there's other debt too. Let me get rid of my little thing here. That are affected by higher interest rates. Credit card debt. You can see credit card debt in the beginning of last year was 14.5%. It's all the way up to 19%, which is just outrageous. So you've got people that have a lot of debt, maybe lower income people that are getting hit with inflation, and they are getting crushed. Also, people are starting to fall behind on their car payments. A lot of cars were sold over the last couple of years at low interest rates. But anybody who is purchasing cars right now, either used cars or new cars, their car payments, not only are higher, but people are starting to fall behind as inflation tears into their monthly discretionary income. And you can see auto loans, used and new auto loans, went from 3.5% at the beginning of the year all the way up to 6.5%, 7%. again, this is, the higher interest rates work their way through the system in a variety of ways. Now, this is a chart that shows real disposable income. Now, real disposable income, this is disposable income after you take into account inflation. And as you can see, inflation is really taking a toll on the consumer and real disposable income. This chart goes back to 1950. You can just see the significance of it. This chart even goes back farther to the 30s. And again, you can see how historic these times are. And this has also taken a big toll on disposable income and savings. So this is the savings rate as a percentage of income. And you can see, again, although it's dipped up a little bit recently, we're going back to the Great Recession times. So a lot of talk about recessions. So let's go show you some data. Now, this is a Gallup poll that came out, I think it came out last week, and it really talks about how it shows how people are feeling. So the green is people who feel they are better off, and this is people who feel they are worse off. So 2020, you can see those who felt they were better off was 60%, and now that is all the way down to 35%. And so people are feeling pretty down with with their personal financial situation, again, given higher interest rates, inflation, and whatnot. Now, recessions, we've probably talked about this in the past. You likely heard this again because this is a telegraphed kind of recession. Is people talk about this inverted yield curve, which I showed you earlier, higher interest rates on the short end, lower interest rates on the long end. And basically, inverted yield curves have been a telegraph of recessions. And I don't quote me on the exact amount, but I think the last 8 or 10 recessions were preceded by a negative yield curve. Now, people had talked about 10-year and 2-year. So the difference between a 10-year treasury and a 2-year treasury, the 10-year was below a 2-year treasury. That's the inversion right there. But as you can see, this shows the inversion. So 0 would mean the 10-year and 2-year are the same. Below that is an inverted yield curve. And you can see, boom, the gray area is a recession, here, recession, here, recession, here, recession, so on and so forth, okay? So that's signaling and has been signaling a recession is coming. You also have people that say, well, it's not the 10-year and the 2-year, it's the 10-year and the 3-month. That spread or that negative yield curve is what really is telling. And so recently, we have seen the 10-year and 3-month invert as well, as you can see right here. So as far as data analytics can tell, a recession is coming. Now, most people think it will be a mild recession, but a recession nonetheless. And this is kind of hard to read, but this will show you U.S. GDP. And as you can see, first quarter of 2022, we did have 2 quarters of negative growth, with which most people would say that's a recession, but with a very strong employment, low unemployment number. Others have said that that doesn't really work in this situation, but we saw negative growth in first quarter, negative growth in the second quarter, and then positive growth in the third quarter, and then almost 3% growth in the fourth quarter. So things are looking fairly decent there. Now, some people expect this fourth quarter 2.9% to be downgraded or revised lower to around 2%. And which is a normal occurrence. They will announce the GDP numbers and then they will revise at a later date. But this shows, okay, in the first quarter, they expect GDP to fall substantially. And then by the second and third quarter, they are expecting, this is they, meaning the so-called market forecasts are expecting that we will be in a recession. So if that yield curve is correct, that negative yield curve, the market is expecting a dip in the economy or negative growth in the economy mid-year to the third quarter. And then we'll start to see a recovery. This will also affect employment. So the conundrum is we have just incredibly low unemployment, but while the economy is slowing, and right now it's 3.5% in December of 22, but as the recession starts taking hold mid-year, we will likely start seeing layoffs, 4% all the way up to maybe 5% towards the end of the year and into next year. And that is the simple reason, earnings on companies are what drive stock market returns. And unfortunately, for those workers who work at public companies, is the CEOs and the board of directors, they're going to cut to the bone to make sure that their earnings are stable. And usually the easiest cuts after they've done kind of their efficiency projects is to cut headcount. Okay, so let's switch over to investment markets. Hopefully that gives you a good idea of the economic landscape. This is where we've been. And so starting in January of 2022, so we've had these drops, and I've talked about this in the past, of all these bear market rallies, up 9%, dropped again, a 13% rally, dropped again, a 10% rally, dropped again, all the way down to minus 27.5% in June. And then we had a 19% rally. Then we went and revisited those lows and went past those lows. I'm sorry, this is 25. This is down to 27 in October. And since then, we've seen another 20% rally. So I'll show you a chart in just a second that shows some possible where we may go from here, according to some analysts. Last year, as we wrote in our performance reports to you, was one of the worst years in the last 50 years of performance of a balanced portfolio. And when I say balanced, it's a mix of stocks and bonds and real estate and things like that. So a traditional, I guess, moderate risk portfolio is the 60-40 portfolio, which is 60% stocks, 40% bonds. And as you can see, last year, 2022, this portfolio was down 16%, which is highly unusual because bonds usually go up when stocks are going down. That's the purpose of bonds, is to provide stability to a portfolio. But with the interest rate increases, bonds did horrible. And so you had both stocks and bonds down last year. And as you can see, during the Great Recession, when stock market was down 50+%, that same balanced portfolio was down 20%. And then we go all the way back to the 70s to witness the same phenomenon. So all in all, it was a horrible year. And but let's go through. This is just to highlight how the bonds did. Incredibly rare to have. The gray chart is where the bond US aggregate, the Bloomberg US aggregate, which is kind of like the index of US bonds. This is where they finished the year up. So you can see, and then the red is where is the low for the year. So the bond index was finished the year down 13% last year. It got as low as 17%. And if you just take a look at the scale here, going all the way back the 90s, the 80s, all the way to the 70s is the worst year. I don't know, 50 plus years. There was nowhere to hide. And so that's what was one of the big culprits in that 60-40 or balanced portfolio underperformance. Now the stock market, this is US stocks. You can see not everything, although the stock market got down, finished down somewhere around 19.5% for a broad index down last year. Not everything was down that much. So you can see the best performing stock was large cap value, was only down 7.5%. Mid and small value were down 12 to 14%. It was the large cap growth, mid cap growth that were down 30%, and small cap growth. So basically what we did is we saw a rotation out of growth into value. Growth had a huge run up for, the last 5 to 10 years. But starting in 2021, as you can see here, we started to see, well, you can see here's large cap growth outperforming 5 out of 6 years. 2021, we started to see value start to, money start to flow into value, and it continued in 2022. Ironically, in January, it went back to growth. And so we'll have to see how that plays out. Now, I've shown this chart in the past. It's a really busy chart. But basically, as we go through here, we have large companies to small companies, value companies to growth companies. Now, I'm not going to show you the chart at the beginning of the year, but these numbers were huge. This shows a percentage of what the 20-year average price earnings ratio is. This was somewhere around, large cap growth was somewhere around 130 or 140, so really undervalued, really overvalued. And value was somewhere in the 80 to 90%, and it was considered undervalued. So basically, as value performed better, it got more expensive, and as growth performed worse, the valuations came down. But you can see there's some areas like small cap, which we have about 30% of our stocks in, are still considered, fairly valued or even undervalued. Now, basically, on the price earnings ratio, just to take a step back again, it's price divided by earnings, or earnings divided by, it's price divided by earnings. And so basically, if the earnings change, the price will change. And so this kind of shows you what the consensus estimates of the S&P 500 earnings is. And typically, we make fun of all the research analysts because they predict every year that earnings are going to go up by 10%. They're wrong every year. They're not even close usually. Earnings may go up 20% when they predict 10, or they may be flat. But in 2023, I believe that the consensus estimates is that 10% were 5%, which in a recessionary year, people predicting a recession, many thought, including myself, thought that they were estimating what earnings would be. This shows you from a couple days ago, with 79% of companies reporting S&P 500, their GAAP earnings were down 23% year over year, the third straight quarter of negative year over year growth. So we saw a huge spike during COVID, coming out of the pandemic, where earnings shot up, but now we've been trickling back down. So when earnings go down, prices should go down, and so it'll be interesting to see how these earnings, if they can, how they will react throughout the rest of the year. Another thing that's happening right now is with higher interest, corporations are facing higher labor costs, higher interest rates. Everything's more expensive. The cost of their goods that they're making are more expensive because of inflation. And you can see it's taking a toll on profit margins. So the profit margins at the end of the year 2021 were like 13.5. Now it's down to 11. That hurts earnings. But the good news is, well, one thing to keep in mind is that the stock market is not necessarily the economy, and the economy is not the stock market, because the stock market typically is looking out in the future 6, 9, 12 months. So basically how the stock market is priced today, Valentine's Day 2023, is focusing on what they believe those earnings will be 6 to 9 to 12 months in the future. So it kind of front runs things. And and basically what this is saying is equities have typically troughed, like the bottom of the stock market is usually 6 to 9 months before the actual earnings get hit. So the moral of the story is, we could very well have reached a bottom already in October, as the stock market is looking forward to the worst of the earnings recession, and then on a go forward basis, they're looking for higher earnings. So hopefully that's the case. Again, we never know. So let's look at the bear case and the bull case. So the bears, there's still a lot of bears out there believe that the market bottom is not in. And, you can see right here that University of Michigan does a consumer sentiment report that just shows how the consumer is feeling, and they are just in the toilet. One of the lowest readings, in a very, very long time, while retail sales are still strong. So it's kind of a conundrum. And basically what that means to me is, again, all this COVID stimulus that people had and all this money, because people put enormous amounts of money in their savings accounts, and then they've been spending through that. And it appears that the stimulus is probably going to be running out sometime between now and the mid-year. You can see it because also I didn't have a chart on this right now, but credit card balances are going up pretty substantially over the last 6 months or so. So people are out of money, and they're starting to put money on credit cards. Now, this chart, although busy, this is from one of the head analysts or economists at Fidelity, and his last name's Jurian. I can't remember his first name, but anyway, a real smart person. So he went back and looked at all these different bear markets, from the dot-com, the Great Recession, the 70s, the 80s, the 60s, World War II, trying to find some patterns on what this market is like, like a market where we had inflation and interest rates going up. And he's narrowed in on the 1946 to 1948 bear market. And as you can see, the black is our current market versus the purple in 1946. And it's pretty astounding how much, the market action has lined up with the 1946-48 market. So if that's the case, and we continue to, if this plays out like that market, you can see we may have a couple more dips before we get out of here. But this pretends, a sideways market for probably another year if this were proven true. So that I'll call that the bear case, meaning the bottom is not in. So we might see some more dips and some more bear market rallies within this. Let's look at the bulls. What are they looking at? Well, the bulls are looking at, this is a chart on consumer confidence. And basically what it says is once you hit a trough in consumer confidence, that chart, that I showed you earlier, it typically, in the past at least, has turned into some pretty significant returns over the next 12 months. You can see in 75, there was a 22% increase from there. And then 1980, 20, 29, 30, so on and so forth. So you can see that looks like a pretty good bull case, considering we've already reached the bottom here. But will it continue? We've already seen a bounce off of the October lows. Will that continue? The bulls say it will. And so we'll have to see how that plays out. Another bull case, don't get caught in all this chart stuff, but this is a bearish trend line. You can see at these tops, and the S&P 500 is broken through that trend line. So from a technical standpoint, people will say the lows could be in, and we may have started our next bull cycle. Similar chart. Here's the chart right here, but also one thing that is to point out right here is the number of stocks that are making new 52-week highs has been growing as this breakout is occurring. So it's a broad advance. That could be very, very good too. And so the bulls, again, have been trading on that in recent weeks and months. Now, this chart, I just kind of threw this in. I didn't know where exactly to put this, but even if we are overvalued, and there might be some dips ahead, not every index is alike. And so basically you can see the price earnings ratio of the S&P 500, 28.5%. I think that number looks a little inflated, but let's look at it on a relative basis. If you look at compared to international and emerging markets, we've talked about this over the last year or so, that international emerging markets look cheap on a relative basis compared to U.S. stocks. And in fact, they did actually outperform U.S. stocks last year. Will that continue this year? I don't know, but they still look cheap on a relative basis. We have about 30 to 35% of our overall stocks allocated to international and emerging markets. So we think we're tilting because we do think there will be higher returns in the future. Will that materialize this year? I don't know, but we do certainly believe over the next 3 to 5 to 10 years that will materialize. Now I'm going to end up with some good news. I showed you this. I included this chart in our performance reports. It's kind of busy, so let me explain. These are the years when we saw a Santa Claus rally, and there's statistics for everything. They can data mine, so let's keep this in perspective. But Santa Claus rally, which means the rally between Christmas and New Year's and into January, when that was positive, and then you had the first 5 days of January as positive. January finished up for the month. You can see the next full year return was pretty impressive. It averaged 17.5%. So again, if in fact the low is in, that could mean it could lead to a very good year. Even if the low is not in yet, and say over the next 3-6 months we go back and revisit some of these lows, that doesn't mean that we won't finish much higher in the S&P 500 returns for the year. Flash back and go back to the Great Recession. We hit the lows in 2009. I believe it was March 23rd was the absolute low, but the S&P 500 finished up 20% for the year. So it had that low followed by a V-shaped recovery, a very, very significant upside recovery. And we're hoping that could be the case this year as well. So, this is one of the things, this chart that shows you got to keep your emotions in check. This is normal what's happening every, call it 7 to 10 years. We do face these bear markets, these extended declines where stock market goes down 20-30+% over a long period of time. It is normal. It's unpleasant. We all hate it, but it is normal. And so walking this psychological cycle is important. You'll go all the way from, hey, I'm so smart, when we're in a bull market, but as we go through these cycles, hey, it's a temporary setback, but then you get to the capitulation stage, and that typically is the bottom. Now, the one thing that we haven't seen that, I don't know if this is concerning, but it is, leads me to believe that it's possible that we might have some downside still ahead of us, is we haven't seen the capitulation stage, which is pretty normal during a bear market. Capitulation stage meaning the bottom, where it's a washout, where people, extreme fear, extreme big zigs and zags in the market, followed by the bottom, which is usually, again, a V-shaped recovery. So you go straight down the capitulation stage, you get a lot of sellers, and then the stock market takes off from there and then enters its next bull stage. We haven't seen that yet. So that tells me that just something to keep an eye on. Now, in closing, just a couple, this is kind of food for thought, okay? We need to keep in mind that patience and diversification works. Diversification didn't work for the last 3-4 years because large cap growth was the only game in town up to 2022. And so if you had value stocks and international emerging market stocks, they underperformed pretty dramatically. So it didn't work, but over the long haul, it does work. And so if you're just patient and you diversify well, do some of the common things we're doing, rebalancing and tax loss harvesting and things like that, it does work. Another thing, just to kind of summarize, I talked about this earlier, the stock market's not the economy. So things could be looking dire today and or in 3 months or 6 months where there's all these job losses, job cuts, and we're in a recession. That doesn't necessarily mean the stock market is going to be going down lockstep. It could very well go up. So they're kind of linked, but they're not the same. And we talked just like the last chart, is understanding risk and reward. It's important to understand that we build these portfolios to manage risk and manage return. Stocks, average, 10+% over the long haul. Bonds average, 5-ish%. And to get the higher returns, you do need to have some exposure to some higher risk assets. And I think the best part is just understanding and us trying to communicate as much as we can that this is normal. These cycles happen. We will get past it. And that's how you get the higher returns. And then, lastly, just know that you don't know. Nobody has a crystal ball of what's going to happen. Hopefully I'm trying to show you some facts, some charts, a bull's case, bear's case, but none of us really know what's going to happen in the short term. And so focusing on, Yahoo Finance or Google Finance, watching the stock market every single day go up and down is I think it's kind of a no offense, kind of a fool's errand because it doesn't mean anything. We don't know what's going to happen in the days and the weeks and the months to come. The one thing we do know is that stocks go up in the long run. And if you're patient, you will be a successful investor. So with that said, that's all I have. And I do encourage you. So if we didn't cover any subjects that you want us to cover, please reach out to your advisors or reach out to me, mark@rscrum.com, and let me know, how we can improve these things, or if we can cover certain subjects that will benefit you more in the long run. So with that said, again, happy Valentine's Day. And until next time, thank you very much for watching.